Right, so welcome back after the break. The short break that was just then, and then the longer break from 2 weeks ago. So what today rounds out is the end of financial accounting, or the end of the financial accounting section of the course. So what we've done over the first 5 topics has been to look at the preparation side of financial statements. To go from economic events, to go from businesses doing, and this is probably going to be, although you can never say never, this is probably going to be the last time I draw this up, so a little bit of nostalgia sitting right here, into a set of financial statements. So that's what we've done over the last 5 weeks. We've stepped through, we've gone through journal entries, we've gone through T accounts, trial balances, adjusted trial balances, closing balances, all of these enjoyable things that we spent lots of time doing, debits and credits. The last few topics, we started looking at little details within this, looking at certain assets, looking at cash flow statements. But the reason we do this stuff is not because it just gives us something to do and it gives me a job and potentially gives you guys work. It's because that information that comes out the end of it is meant to be useful for people to make decisions with. So when you've got users sitting outside here, and there are lots of different user groups. Obviously investors are a big user class. You've got creditors who are potentially lending money into businesses. You've got the government's interested. You've got customers who may be interested if they've got a longer term relationship. You've got lots of different user groups who are interested with what's in financial statements, because ultimately what's in financial statements is a model of what's happening within the business, and that helps us understand what's going on with things. So we just touched on Facebook very recently, and they went IPO a few years back. Prior to that, it was a private company. No one external to them, or no one external that they didn't want to, other than those that they wanted to have it, had any idea of what sort of money that they made, were they profitable, were they not profitable, did they do things? And it actually turns out when they release their statements as part of their prospectus for their IPO, they make a ton of money. It was even back then, it was a ton of money. It's an advertising platform, like 85% of their revenues, and this was back 5 years ago, 85% of their revenues was advertising. That's what Facebook is. It uses our information to target ads. For better or for worse, that's what it is. So what we're going to look at, and this is jumping ahead a little bit, and I know I do this, but I think it's relevant. It's sort of, instead of just going slide by slide, just the idea of what we're trying to do today is to understand some of the techniques. Now that we've known what's gone into these statements, we're going to look at some of the techniques we can use to see what's going on within them. Now, to be honest, a lot of these are actually fairly intuitive. Like you look at that and go, well, yeah, of course you'd do that. And that's a good thing. But what we're going to do is just sort of unpack some of them. But before we jump into that, just a caveat that financial statement analysis or financial statements are just one piece of the puzzle. They're not everything. There's a lot of other information about companies. There's a lot of often more timely information about businesses and about companies that you need to be looking at. So it's important information, but there is other things that you should be aware of. What's going on in the economy more generally? What other news reports and information that come out? What press releases and media reports and market announcements that companies put out there? Because an annual report by its very name comes out once a year. A semi-annual report, which Australian companies have to report on a semi-annual basis, they'll have 2 of these reports a year. In the US, where they have quarterly reporting, they'll have 4 reports. That's only 4. That's once every 90 days. Trading happens round the clock. So you need to look at other information that helps you make these decisions. But before we go any further, happy Star Wars Day, everyone. Sorry, anyway. It's May the 4th. So what we're going to be looking at, there's 3, we're going to ignore we're not really going to touch on DuPont analysis. It's not something that we feature heavily. In future iterations, we'll probably drop that one out. We've kind of talked a little bit about the front end, to understand the nature of financial statement analysis. The second one often breaks into two. So we talk about horizontal, which, as the name suggests, is when you've got a set of financial statements in front of you. Horizontal analysis looks across the page. Vertical analysis looks down the page, so kind of makes sense. So we'll look at those. We'll then look at 3, 4, and 5, which is looking at specific ratios. Now, before I go any further, with the ratios, you won't need to memorize the ratios. If you need to use ratios, this won't hold for every single ratio in particular calculation throughout the rest of this course, but for financial statement analysis, we will provide you ratios as needed in any sort of assessment. What is critical though is you know what these numbers and these outcomes, what they mean. So it's not really going to be about the calculation of these numbers. You need to know how to calculate them, but it's going to be about using these numbers that come out of these calculations. That's what's important for us. Because realistically, as you're going to see, because I'm going to do a lot of this on Excel, now you guys will have to do it by hand in any sort of assessment, but we have computers for this stuff. Like, there's no benefit training you guys up just to remember a formula to punch in buttons. That's not value adding. What's value adding is understanding what those numbers tell you about the business and what you can understand about where the business is going. So comparative purposes, you need to look at this information and you need to compare it to something. And that's important, because if I tell you that I made as a salary $50,000, and I ask you, is that good or is that bad? Is it? Is it good or is it bad? Well, no one has a...
You compare it to someone.
Well, it is comparing it. But what do we, when I say I've made a salary of $50,000 or I made $50,000, what are we immediately assuming? Over a certain time period, over a certain year. Like, often we'll think, well, $50,000 over a year. $50,000 in this country over a year is pretty average. It's probably under full-time earnings, average full-time earnings. Over all earnings, full-time and part-time, it's probably a little bit above average, but it's not fantastic. That salary in Australian dollars, the equivalent in other countries, without naming, may actually be quite good. $50,000 over 6 months is better. $50,000 over a month is much better. $50,000 a week is much, much better. But you talk about a lot of footballers, especially European footballers, they talk about, you know, how they'll make £30,000 a week. That's a lot of money. So there's a comparison point that we need to make. So if a company makes $1 million, or if a company makes $500 million in profit, that could be incredible. That could be actually a bad year for them. You've got to relate it to something else to make it relevant for what you're trying to do. So what we have with financial statement analysis is giving us some tools to be able to do that. So we've talked a little bit about this, and the first one we actually did last 2 weeks ago when we looked at Qantas. So the first thing you want to do is compare the company to itself. So you want to compare the company, how it performed last year, and then the year before that, and the year before that. At least, 2 years just gives you how they went this year to last year. That's a starting point, but you actually really like to see 5 years, 10 years of data just to see how they're going. So common benchmark is intra-company, so it's just over time. Think about athletes. This is what they do. This is a personal best. So look, I'm not going to say, because that sounds a bit conceited. I'm not an athlete. So it's not being conceited there. I run to work. I was cycling to work until my bike had a few flat tires, and now I haven't fixed it yet, so I'm running to work. So I'm running to work, and I don't know if you guys, but I use Strava, so I sort of keep a track of my times. And this morning was actually my best time running in over all the times that I've run in. So I'm pretty happy about that. So for me, as an intra-company comparison of my time to run to work, I'm pretty happy. It's trending in the right direction for me. But I'm pretty sure, so that's good for me, I'm doing well. But I'm pretty sure if I got, you know, a professional marathon runner to do the same distance, they'd smash me. So whilst on an intra-company comparison I may be doing well, when I'm comparing myself to someone else or a competitor, I may be doing really terribly. I've just done well for me. So yes, it is important to see how you're going within your own company, within your own organization, but it's also important to compare it across companies with competitors. So if you're looking at Woolworths, you want to compare it to Coles. If you're looking at Qantas, you'd want to compare it to Virgin, so on and so on and so on. The last one is pretty much a benchmark across companies, but not just one competitor, it is across the entire kind of industry. So if it was Qantas, it would be against other airlines as an aggregate. So just to see where you stand. So horizontal, over time, vertical, within the statement, and we'll look at that. And ratio analysis is sort of a mixture of playing off different numbers within the statements to different numbers within the statements. And we'll look at three blocks of important ones there. Right, horizontal and vertical. Horizontal, over time. Two numbers that we want to calculate for each line item in there. We want to calculate the absolute difference. So we can see it here that we have for cash a $20,000 absolute change. And we also want to calculate a percentage change, which is that absolute change over the early year. The early year is the benchmark. Now, what I've handed you guys out, and you should all have a copy of because we're going to look at it now, is let's do this rather than with some made up company. Let's do some of this with a real company and just see if we can learn some things from this. So what we have is the consolidated profit and loss statement for Woolworths. So you should have this in front of you. Now, with this, there's a lot in here and we're not going to use everything. Okay, so, and there's some simplifications I'm going to make. So just keep a note of what I'm doing. An important thing we need is revenue, so a top line number. Now if we look at the statement here, we've actually got two items, revenue from sales of goods and services and other operating revenue. Just for ease of use, I'm going to collapse these down and we're just going to take total operating revenue. So we're just going to take that as the revenue figure. Cost of sales we're going to take. Gross profit we're going to take. These three, other revenue, branch expenses, administration expenses, I'm going to collapse down and just call them expenses. So I've totaled these up, you'll see in a moment, but I'm just going to take these as just together. What we then get left with is EBIT, or earnings before interest and tax. Financing costs, which we'll use, we can just kind of consider that as interest. Profit before income tax, or profit before tax. Income tax expense. And then profit for the period from continuing operations, 840. So we're ending at that point. So the $840 million, we're not going down further to look at the impact of the discontinued operations. Yes, they did really lose $2.3 billion that year. Yes, the loss from the discontinued was $3.2 billion. That did happen. That has obviously affected their statements. However, what we're interested from an analysis point of view is we're interested in the future. We're interested in what's going to happen. So we're actually going to split that out and just focus on the continuing operations. So having had a look at this, let's flick to something I've sort of made earlier. And you guys can do this in your own time, but you'll note that the numbers match up with what's in the handout that you have. So if we're looking at horizontal analysis, what we're doing is, from an absolute point of view, taking 2016 and taking it away and then deducting 2015. So what we can see is revenue has dropped by nearly $750 million. Cost of sales has dropped by $250 million. Gross profit is down heavily. Expenses are up by nearly $1.5 billion. Like, that's a big jump. Means your profit's down, before tax is down, interest is about the same. Profit before tax is down heavily, tax expense is down, which makes sense. You've made less profit, tax should be down. So net profit after tax, so this is profit from continuing operations after tax is down by about $1.5 billion year on year. Now, as a percentage, so that tells us something. As a percentage, we'll use the early year as the base year. So that $750 million in revenue, that revenue drop, is a touch over 1%. Like, that seems like that's a lot of money. But because their sales are that big, that's not a huge percentage change. We then roll through all the other changes which have taken place. Cost of sales are down by not as much as revenue. So something's going on there, because gross profit as a percentage is down. So that would indicate either they're selling the items at a slightly cheaper rate than what they were before, or their suppliers are screwing them a bit, which, given that industry, is probably hard to do. Expenses, this is probably the critical one. And so if you're looking at this company, I suppose the two things that kind of immediately spring to mind. Yes, the net profit is down by 2/3. Like, that's a big drop. But the things which are really driving this, revenue is down by a lot and expenses are up. So this doesn't give you a solution. I don't know why this has happened. I don't know. Maybe you guys do, maybe you guys don't. But what it at least does is it gives us an avenue to go, okay, well, hang on. Revenue is down, so then you want to explore, why is revenue down? Is it this is becoming an increasingly competitive industry and they've got a discount to stay alive? Is it just general economic conditions? It's just sort of recession type situation where lots of people are in trouble. I don't know, but at least it gives you something then to do some research on to figure out, okay, well, do we expect this trend to continue? With expense, that expense is up by 12%. Okay, that you're kind of like, well, that's a big number. Are they legitimate expenses? Like, what's gone on that's driven that? Do they think those expenses are going to lead to something better down the track? Again, I don't know what they're about, but that's something that you can explore further. If you're an analyst, which is then involved in conference calls with management, you're able to ask them these questions. Like, we see this has jumped. Why is this the case? How are you dealing with it? But they're giving us some way to think about this. So that is horizontal. I was going to say that's horizontal. That's horizontal. And you do the same with your balance sheet. And we're not going to, for time-saving purposes, I'm not going to do it here, but you do the same thing and just sort of see what it tells you. You definitely like more than 2 years, just to give you a sense of if there's trends going on. Vertical analysis is you're looking down the statement, And this allows you to get a sense of what your profit is composed of, and then also with your assets, what's your capital structure, which will both be quite important things as we move through. So with this one right here, if we're looking at vertical, for a profit and loss statement, the base number that you use is revenue. So everything is a percentage of revenue. And, yep. So revenue as a percentage of revenue is obviously going to be 100%. I'll just roll this down. Okay, so immediately what we can see is profit as a percentage of revenue. So whereas in 2015, they made $3.90 for every $100 in sales, 2016, they were making $1.40 in every $100 in sales. So they're making less than half the margin. And again, a lot of that is driven by the expenses. Expenses are taking up an extra nearly $3 per $100 in that margin. They're making slightly less on their gross profit. So it's marginal, that change, but it's still a change. Yeah, so I mean, that just helps give you a sense of what's going on. And again, that's really heavily driven by that. The good thing, a handy tool for vertical analysis, or the reason why it's good, is it creates what's called common size statements. Because what we've done with vertical is make everything as a percent. So we can then compare different size businesses. So if you've got Woolworths who make $58 billion in sales, and then you've got another company that makes $30 billion in sales, you make them as a percentage of their revenue, each of them, and then you can compare their cost structures a little bit more equally. So it allows you to compare between companies of different sizes. Now, there is a caveat with that, which is you've got to be careful sometimes on, like, you can't have a really small business compared to a really, really super big business. They're going to be really different. And the example would be, if you think of Soma, just the coffee shop just on the corner. I pointed to the corner, everyone was like, yep, it's just there. So Soma on the corner of Harris and Ultimo, coffee shop. Starbucks is a coffee shop. Soma's got like 2 locations. Starbucks has a location that you basically walk around a corner and there's another one. And there's Starbucks across the road from Starbucks. They've got hundreds of these things all around, thousands of these things all around the world. Yes, you could make common size, they're in the same industry, but it would be kind of silly to compare them because they're just in completely different niche, in sort of spectrums of the market. So just be careful about what companies you're comparing to what companies. So we've done the vertical over there with that. What we've got down here, and if you turn to the profit and loss statement, you can see all these items. So if you've got, the balance sheet. So you should have a statement of financial position. I've just taken, with the exception of inventory, I've just taken the 4 key subtotals. So current assets, non-current assets, current liabilities, non-current liabilities, total assets, total liabilities, total equity, and then, because we're going to need it later on, I've included inventory. So you can see that they've got $23.5 billion of assets, $14.7 billion in liabilities, and $8.7 billion in equity. That all comes from that financial statement in front of you. In terms of what we use as a benchmark for the balance sheet, we use total assets. So if we look at current assets in 2016, current assets are 31.6% of total assets, and so on. So total assets are 100%. Liabilities are 62%. So they have more debt than equity in the business. We then roll that across. Current assets have gone up slightly as a mix. Inventory's gone up slightly. Non-current assets, current assets have gone down slightly, I should say, have gone up slightly, and non-current assets gone up. Total liabilities have gone from 56% to nearly 63%. So it's the amount of leverage has gone up substantially here. And that may be cause for concern, because I mean, obviously leverage, and we'll get to that in more detail in a few moments. But you look at that just as a percentages, it's gone from 56 to 63. Now, not saying just higher is worse for leverage, because if you got very, very low leverage, you could probably actually borrow some money and do something efficient with it. But what it seems to be driven by, if you then look at the actual numbers, isn't the fact that they've borrowed a lot more. If you look at it, it's gone from 14.2 to 14.7. Yeah, it's gone up by $500 million, but what really is driving this is the fact that your actual equity number has gone down. So equity has gone from 11 to 8.7. That's because you've had this massive write-off. That's effective retained earnings, so your equity figure's gone down. So if that write-off hadn't have happened and they'd still borrowed that a bit extra, this as a leverage amount, this percentage probably wouldn't have changed all that much. So it's not like they've gone off and borrowed a whole lot more. But in saying that, that ratio has still gone up. So that is still something you want to keep an eye on. Yeah, we've already talked about that. Done an example. Okay, so now into the financial ratios. Ultimately, although you could argue, one of the biggest reasons people invest is to make money. That's why you invest for the most part. Now, it's not the only reason people invest, and when I'm thinking about that sort of stuff, I'd imagine thinking about billionaires investing in sporting teams. So billionaires that buy football clubs and buy other sort of sporting teams, for the most part, if you look at the financials of a lot of these sort of clubs and these sort of franchises, a lot of them lose money. So I don't think these guys are necessarily, and it is generally men who invest in this stuff, these guys are necessarily investing to make money. I think they're investing because they like to have a plaything. So, you know, there are other reasons to invest, but for the most part, what we're interested in is investing for profit. If you're going to make money with your investment, the company that you're invested in needs to be making money. At least if not now, at some point. So looking at profitability is a pretty important thing. Yep, so profit is an important thing. The profit number by itself doesn't reveal how efficiently and effectively those profits were generated. And if we go back to the Woolworths profit figure from continuing operations this year, or in 2016, $840 million. If you just get told that you have a business and it made $840 million, that sounds awesome. Then you get told that that same business made $2.3 billion the year before. That 840 suddenly doesn't start to sound so good. So one figure in as of itself in isolation doesn't tell you a lot. You need to look at it in comparison with other things. Now, as a side note, and we're going to see some of this in action, the thing that you'll often see, and I don't know if you see it on the sort of current affairs shows and mainstream media from in your home countries, but you certainly see it a lot here, where they'll usually have a crack at the banks every time the bank comes out and reports its profit figure, and they do make a lot of money. But if you look at how big the banks actually are, that's on the amount of revenue that they generate, it's not a huge figure. When you look at Woolworths made $840 million, like that's a big number, but $840 million off nearly $60 billion in sales, it's suddenly not such a large figure. They're making, as we've just seen, and it's actually the first ratio, the profit margin ratio is, if you want to think about this, is just profit, total comprehensive income or profit over sales. What it's telling you is for each dollar in sales that they make, what's their margin? What are they actually making in profit? So with Woolworths, we've already done that. And we've actually done it because it's part of basically, it's that figure right there. Oops. Because this figure, if we bring it up, is net profit after tax, profit over revenue. That figure here is your profit margin. So Woolworths in 2016 had a profit margin of 1.4%. So for every $100 that you buy in the supermarket, they made $1.40 in profit. To me, that doesn't seem like a massive margin. It's not like it doesn't seem like they're gouging you hugely. If that was like 15, 20%, yeah, you could probably argue the fact that they're sort of gouging a bit, but it's not. It's 1.4%. It was only 3.9% the year before. It starts to give you a better sense of what these things are created from. Now, and I'm not going to use Woolworths for this one. I'm actually going to jump to return on assets first. And what we're going to do in future lessons, I'll flip that, and because what I want to do here is actually bring together a few different ideas. So return on assets. I'm going to simplify the calculation for just here and now. So for the example I'm about to do, I'm not going to do it as average, just to make the numbers easy to work with. So return on assets is the return that you get from all the assets that are working for you in that business. Not just the money that you put in as the owner, everything. So let's take two examples, and we'll just look at this now. Return on assets. Let's imagine a situation where we've started up a business and we've put $1,000 in. So $1,000 cash we've put into this business. The balance sheet, that's all that we put in. Balance sheet will look like this. Assets of 1,000, liabilities of nothing, equity of 1,000. Business runs for a year. Turns out we make a profit of 100, what's going to be a good figure? $100. So after a year of operation, we made a $100 profit. Now, just to make this a little bit easier, I'm not going to add it to the assets and equity, but obviously that would happen. If we were to work out what the return on assets are based on the assets that we put in, we made a $100 profit. We put in $1,000 worth of assets. Return on assets is 100 over 1,000 gives us 10%. So our return on assets is 10% in this example. Say we have an alternate example where we have $1,000 invested and we borrow $9,000. So we have assets of 1,000, liabilities of equity of 1,000, I should say, of 1,000, liabilities of 9,000, and assets of 10,000. So that's what we put in. Then we've gone down to the bank or wherever it happens to be, borrowed 9,000. We've got $10,000 that is invested for us. We still make a 10% return on that. So our profit would actually now be, our profit would be $1,000. Return on assets, 1,000 on 10,000 is 10%. So the actual, how well the assets in play are working is the same. We just got more of them. And so our return on assets is the same, but the amount of profit is bigger. So that's return on assets. Return on equity, at the end of the day though, if I'm the owner of this, I'm not worried about what my return on my assets are. At the end of the day, I'm worried about my return on my equity investment. That's what I'm worried about. Return on equity is the same idea, except instead of over assets, it's over equity. So in this case, it's 100 over 1,000 gives you 10%. It's the same number in this case because there is no debt here. Your assets and your equity are the same number. And I'm pretty sure everyone is ahead of me on this. On this case, your ROE is 1,000 which is your profit, on your equity, which is 1,000, is 100%. It is the same return on assets, but magnified when you look at your equity because you've borrowed to make it happen. Now, I've simplified a lot because you'd actually have to take your assets would have gone up, your assets would have gone up with the profit, your assets would have gone, so you need to kind of take the average of the assets and the average of the equity to calculate it. So I've been just for ease of use for calculations now. Plus, when you're borrowing money, your profit would probably be slightly lower because there'd be interest cost on this $9,000. So you'd have to take that into account as well, and your profit would be a little bit under that. But you get the idea that return on assets, return on equity, when you have no debt in your capital structure, is going to be the same, and it's going to be magnified substantially when it's over here. That looks awesome. Like, why would I want a 10% return on my equity when I could get 100% return? Like, that looks amazing. Let's just all do that. The flip side of this is, what happens instead of if you make a profit, you make a loss? In this case, your loss is a 10% loss. You've lost 10% of your equity. You're going to have $900 of equity left. So, you know, look, that hurts. Not the end of the world. And again, you know where I'm going with this. In this case, if you made a loss of $1,000, 10%, still just a 10% return on asset loss, like negative 10%. So, you know, that's not massive. But your company's dead. And we laugh about this, but I mean, there were banks who went to the wall 10 years ago, 8 years ago with the GFC because of exactly this. That's a 10%, well, this is, if on assets, 10% equity, 90% debt. There were banks in the US who were 3% equity, 97% debt. So you can imagine when things are going well, like that's much more than this. So 10% return on assets, their return on equity was enormous, but then when things go the other way, you get wiped out really, really quickly. So, but we're going to talk about leverage in a few moments. So return on assets, return on equity, earnings per share. Now, earnings per share, take your consolidated statement of profit and loss. Everyone is looking at that. I can see we're looking around the room. Take that and then look at the very bottom. And it's got earnings per share. We actually have, like, it's already here for us. We're going to just work out how to calculate it very quickly and just check what they've got is what we get. Now, what they have there is earnings per share attributable to equity holders of the parent, and then earnings per share attributable to equity holders of the parent from continuing operations. Because we're focusing on continuing, we're just going to look at those bottom two numbers. They have basic, and then they've got diluted EPS. We're not going to worry about the differences between those two here. Not something you need to worry about. But in any event, if you look at those two numbers, they are exactly the same. So not relevant for us. 63.6 cents per share. To calculate it, you need total comprehensive income or profit, and you need the number of shares that you have. If you look on the profit and loss statement, they do not have anything about the number of shares. If you look at the statement of financial position, it doesn't tell you anything about the number of shares. If you look on the sheet with shareholder information, we have number of shares. And you can see that there's 1.28 billion shares on issue amongst 457,031 shareholders, of which I happen to be one. So I don't get much of a say in what goes on. So what I've got here is we've already got the number of shares, so that this is in the millions, so this is in the millions, and all that we do, earnings per share is profit for the entire company divided by the number of shares for the entire company. We need it. Gives us 0.66. Now that is slightly higher than the number they've got calculated, and I would imagine that's because there have been shares issued through whatever means over the course of the year, and we haven't taken the average, so it's out slightly, but it's not out by a lot. So what that says is that each share that this business has made a profit of 66 cents. You can't compare EPS from one company to another because different companies will have different number of shares on issue. So it's actually, that on its own is a completely useless thing to compare to other companies. Often analysts will talk about target EPSs that they're after for a particular business. They won't talk about the overall profit target, they'll talk about an EPS target. So what we've calculated is important, but for comparison purposes, not so much. Why we have EPS is because it helps us do the next thing, which is calculate the price-earnings ratio. And what the price-earnings ratio does is indicates a perception of the market to that share. And the critical word there is perception. The market doesn't always get it right. In the longer term it will, but in the short term there will be spikes and there will be they'll get excited by something or they'll get scared by something, so it happens. So at any given moment it may not be absolutely spot on, but what it means, so if you've got a price-earnings ratio of 10, and we're going to calculate Woolworths in just a moment, if someone has a phone or a laptop and can just look up either on Yahoo Finance or on the ASX what Woolworths' current share price is, that would be really, just keep it in mind for the moment. The price-earnings ratio of 10, what that means is that for every dollar of profit that that company makes, the market will pay $10 for it. So then you sort of go, well, why would they want to, you only made $1 in profit, why are you paying 10 times that? And that's because when you buy a share, you're buying future profit. You're buying not just sort of current profit, you're buying all that income stream profits in the future. The more that you're willing to pay for it, the more the market's willing to pay for it, the more bullish they are about what's going on. So a higher price earnings generally indicates they're more optimistic. Just to give you a sense, just before we calculate this ratio, the historical PE ratios for the Australian market range between about 12 to 16. If you're looking at FTSE over in the UK, if you're looking at the NYSE, it's in that sort of range as well. Then that sort of 12 to 16 PE ratio, that's about sort of normal market conditions. If it's above 16, 18, 20, markets kind of thinks good of this company. If it's less than 12, less than 10, they're not so positive about it. Again, doesn't necessarily say the market's right. Did someone find out what Woolies' price is? $26.43. So their current price is $26.43. So currently, the market is paying $26.43 per share, and 2016 they made 66 cents per share. So if we take price divided by earnings, we end up with a PE ratio of above 40. So the market seems to be quite excited by Woolies. Now, why that happens to be, again, from what we're talking about here, we don't know, but it gives you something to go on. Liquidity. Liquidity is important. If you don't have enough money to pay your debts, you're in a world of hurt. And you may have, I was going to say, I talked about the too big to fail. I mean, liquidity was a major issue that these guys had. They had, a lot of these institutions, Lehman being one of them, they had to repay billions of dollars within a 24-hour period. That's how often a lot of these banks are being financed. They finance themselves with repurchase agreements where they're sort of rolling things over on a nightly basis. So if suddenly you can't do that and you have to repay a lot of money very quickly, it can be hard to do so, and you may end up in administration. So what a liquidity analysis does is looking at your ability to meet your short-term obligations. probably one of the core ones that we look at is the current ratio. So again, how to calculate it is pretty easy. It's current assets divided by current liabilities. But it's not the calculation that you guys need to be all that worried about. It's what does this tell you? So current assets are the things that you have that you think you're going to be able to turn into cash in the next 12 months. Current liabilities are the things that you owe in the next 12 months. We're just looking at a ratio between them to see basically can you pay off the things which are due coming up. So if we look at Woolworths, their current assets are 7.4 billion, their current liabilities are 8.9 billion. So already we can tell that it's under 1. They do not have enough current assets to pay all of these if all of these wanted their money straight away. Like we can see that straight up. So the current ratio, if we're going to actually calculate it, is current assets divided by current liabilities gives us 0.83. And the prior year is 0.84. Hasn't really changed an awful lot. It's under 1, which is a little bit concerning, but this may be just how they operate. You'd like to see a trend of data sitting there, but it is what it is. Where are we at? All right. Question for you guys. So have a turn to the statement of financial position. Where are we? Okay, we're just going to look at current assets. There are 4 current assets in there: cash, trade receivables, inventory, other financial assets. So we've looked at the current ratio, which is all your current assets, all your current liabilities. But if someone comes knocking on your door, if all of those current liabilities, all those trade payables, and there's a lot of trade payables, if you look at them, $6 billion. Did I get it right? Yeah, $6 billion in trade payables. That's almost all your current assets. If they, for whatever reason, come to us and say, we need our money and we need it now, of those current assets, what are going to be easily convertible into cash quickly? Yes, you've got the low-hanging fruit there. Cash is going to be convertible into cash pretty quickly. So that's one done. So cash is going to be pretty easy to convert into cash. What else is going to be relatively easy to convert?
Financial assets.
Yeah, I'd say financial assets and potentially also assets held for sale, because these are things that you should be able to get rid of pretty quickly, because financial assets will be fairly liquid as well. So those should be pretty quick. So we're left with trade and other receivables and inventories. What do you reckon? Yeah, inventories of your current assets are probably the least liquid thing in there, because that's the stuff that you sell anyway. That's the stuff that you're selling as part of your normal operations. How would they, if they needed to get $4.5 billion in inventory, that is literally the supermarket, if you imagine Woolworths, selling everything is gone. Everything. That's pretty hard to imagine. What would be a way in which they could try to make that happen?
Offer discounts.
Yeah, you only do a fire sale situation. If it's discounts, you look at all the, I don't know, I haven't actually seen too many Persian rug sales lately, but you see a lot of Persian rug sales where it's 90% off, closing down sale, and they just try to get rid of everything. They would need to discount really heavily to make that work, but then you're not going to generate much cash from it, so it's sort of what's the point? So there's a concern when we're looking at our ability to pay debts really quickly if we should include inventory in there. So one of the methods, a tighter version of, whoops, what's happened? A tighter version of the current ratio is the quick ratio, or sometimes called the acid test ratio. Acid test. This is worst case scenario. we still have all our current liabilities on the bottom, but if you look on the top, what you see is cash, short-term investments, account receivable. Basically, the number that you don't see up the top is inventory. It's your current assets without inventory. And let's see how quickly you can do things. And so in this case, the quick ratio would be our current assets, our current assets minus inventory, all divided by, bless you, current liabilities, gives you 0.32. If they need to do things really quickly and all those people came asking for their money, they would be able to repay quickly about 1 in every $3. Now look, it's odds on it's not going to come to that. So that's why it's a really kind of worst case scenario, but it helps give you a sense of what's going on. If you saw major, it seems to be holding. If you saw major sort of declines in these sort of things in a business, you'd probably start to get worried. But in this case, it looks like it's staying fairly stable. Receivables turnover. We won't talk about receivables turnover for Woolworths. And the reason we won't is just because of the nature of the business it is, a lot of its sales won't be on credit. They'll be cash-based sales. So it's not something we're going to focus on too much. Well, okay, just for today, just in the interest of time, but I will look at a turnover ratio, which is a lot more relevant for Woolworths, which is the inventory turnover ratio. It's a turnover. It's calculated the same way, just looking at something different. So inventory turnover ratio is, as the name suggests, it's how quickly you turn over your inventory. It's how quickly you sell the stuff. The higher the number, the more often that you're selling these things. So to calculate it, we need cost of goods sold and then your average inventory. So for here, we have cost of sales of $42,676. And we've got inventory of it'll be about 4.6 billion. So our inventory turnover will be cost of sales of 42.6 billion divided by average inventory. So once you've done that, and again, I'd urge you to calculate all of these with these figures at home when you get the opportunity, you end up with a ratio of 9.05. If we rolled it, could we? No, that doesn't work because we've got that in there. So don't worry about that. So what they're saying is they sell, on average, their entire stock of inventory. They do that 9 times per year. The quicker they do it, the higher that number, the more they're selling their stock. But you can't say whether quicker on its own is a good thing. Quicker holding everything else equal is a good thing, but you could be selling your stock quicker by discounting your stock, and that may not actually be a good profit impact. So you've got to kind of think about that. It's not an explicit ratio up there, but you could actually work out days to sell, something like that. If we sell everything out 9 times per year, if we took the length of a year, divided it by that, that tells us that on average, we sell our stock in total 40 days to cycle through everything. Now, obviously that's an average because I'm pretty sure, well, I'd really hope that the milk in the fridge isn't been sitting there for 40 days. Like that would be a bit troubling. But that helps you sort of get a sense of it, and it makes it a little bit more real. It goes, okay, 40 days, they're cycling through everything. You want to see that number start to reduce. Right. Where are we at? Solvency. Cool, we're in the home stretch. We're making good time, there will be some time at the end. Solvency is more of a longer term health situation. Now, you guys already know, you guys actually know this. I need everyone's attention for this. So imagine you guys, and think about it in your head for the moment. you have some money to lend. You've got tens of thousands of dollars, and you have company A and you've got company B. Other than that, same idea, same all the rest of it. One of them comes to you and says, this is what I look like. Another company comes to you, and that's what my capital structure looks like. Actually, let's change it up. So it's 10,000 and 10,000. I'll change that to profit. So both companies have 10,000 in assets. Both companies made a profit of $1,000. Company A has no debt and 10,000 in equity. Company B has 9,000 in liabilities and 1,000 in equity. If they both came to you, other than that, they're all exactly the same, which company would you lend money to? A? A? You come from the banking system, you should be all. What about on the back? What did Jimmy, Ray, Dennis, what do you guys reckon? What do you reckon? Which one would you lend money to? It's good to pay attention sometimes. Otherwise you don't get caught on the hop like that. So I think most of us would agree that A would be the logical place, that A would be the more likely company that you would lend to of those two. B, you're probably not going to. So intuitively, we know the answer. Intuitively, we know that this company is a better risk. You just got to make sure you're comfortable as to why that is. So think about it in terms of, if you've got debt, you've got to pay for that debt. You've got interest costs over that. That's going to affect your cash flows. If you're lending to them, they're already getting their cash flows and their profit reduced because they're paying for interest. So there's an issue there with their ability to service debt because they've already got a lot of debt they're dealing with. These guys don't have that problem. Additionally, if something goes wrong with these guys, you're in a pool with another $9,000 worth of people that they owe money to. In this case, you would be the only person that they owe money to. So riskiness of getting your investment or getting your loan back is lower with this guy. So we actually know the answer to this. So that's why we calculate some of these solvency ratios. Now these two numbers, or these two ratios, debt to assets and debt to equity, are interchangeable from my perspective. I prefer debt to assets just because I just prefer it. You guys, some of you may prefer debt to equity, but they're going to tell you the same thing. The number will be different, but they'll tell you the same thing. So with company A, debt to assets, total liabilities over total assets is 0. So 0% or 0, whatever it wants to be. They've got no debt. They're not leveraged at all. This guy is 9,000 liabilities over 10,000 assets is 90%. They've got 90% debt to assets. They've got nothing. The higher the number, the riskier they are. Debt to equity, again, it's just a different way of thinking about it, is instead of debt to assets, it's just debt to the other one. So debt to this is 0. On this side, it's 9, because it's 9,000 over equity of 1,000. So it's just a ratio of 9 at that point. But ultimately, the indication of these, they will tell you the same thing, just in a different way. Think about it as degrees in Celsius versus Fahrenheit. Think about in distance in kilometers versus miles. It tells you the same thing. The numbers will be different, but it will tell you the same thing. And the very last one, times interest earned. What banks do this when they lend money to us as individuals. They want to know our ability to repay. They want to know, can we service the repayments that are going on with this. Now this isn't the full repayments, this is just about the interest component of them. So what the times interest earned ratio is basically taking how much profit do you make, and of the profit that you make before you pay any interest payments, how much can you pay off your interest load at this point? So we'll see what that means. So times interest earned. On the bottom, on the denominator, we've got the interest expense. So that is how much your interest costs are. We want to know basically how much profit before we pay any interest we earn so that we can pay off this interest expense. So if your ratio is 1-to-1, it means all of your profit, everything that you earn before interest and tax is used to pay your interest costs. So your profit after interest will be 0. You'll have no tax, so your profit after interest and tax will be 0. If it's less than 1, you're making a loss after you pay your interest. So really, you want to have this number positive. You need it, sorry, not positive, you need it above 1. So if we look at it here, this number here is bottom line profit, add back interest, add back tax. This is earnings before interest and tax. This is EBIT on top. So what we have is times interest earned is EBIT on top, and I'm going to use financing, as we talked about earlier, as your interest, as a proxy for interest costs, is 6.54. And you can kind of see that. So earnings before interest and tax is 1.6 billion. Interest costs are 245 million. They're well covered in terms of their ability to pay their interest. Like, that's not an issue. I'll just scroll it back to last year, but it has got worse. The same ratio last year was 14. Now it's down to 6.5. That trend is not, 2 years doesn't make a trend. We'd like to see it before that, but if that is a trend that's continuing, would be of a concern to their lenders. But what's caused it is not driven by them taking on a lot more debt. Their interest costs have actually gone down. Their interest cost was 253 last year, now it's 245. So their interest cost has decreased. So this hasn't gone up because they're paying a lot more interest and they borrowed more. This has gone down because their profit has gone from 3.5 billion, or their EBIT has gone from 3.5 down to 1.6. That's causing them the problem. It's not that they've taken on a lot more interest. So again, if that profit was to continue to decline, that would be an issue. And these are the sort of things you can start to see how we're trying to create a trend, figure out what's going on, figure out if it's going to continue in the future, try to isolate issues which are coming on.